Welcome to the Opening Bell Report.
We're really thrilled you're joining us today.
Yeah, absolutely. Glad to be here.
Because today's mission is, well, it's all about unpacking a brand new analysis report on the Q4 2025 earnings release from a company that's been, a bit of a lightning rod in the energy sector for years.
Oh, definitely. PL Power.
Exactly. PL Power. And if you've been tracking the green hydrogen space, you are intimately familiar with this narrative.
Right. I mean, for the better part of a decade, the story with this company has been defined by two very conflicting metrics.
Right. You've got this towering top-line revenue growth,
but paired with a seemingly bottomless cash burn.
Yes, exactly. But we're looking at their Q4 and full year 2025 financials today. These were just released today, March 2nd, 2026.
Right.
And the data in this report is signaling a historic turning point.
It really is. PLG's roadmap to profitability is finally coming into focus.
And we are going to break down exactly what you need to know as an investor, or really just anyone following this space.
Because it's a pivotal moment. And looking closely at these financials, it's crucial to recognize that this extends far beyond just a single company trying to repair its balance sheet.
Right.
This represents a critical maturation phase for heavily industrialized green tech as a whole. I mean, for a long time, the entire sector has operated on the promise of future economies of scale.
Like, we'll be profitable eventually, just trust us.
Exactly. But what we're seeing in this analysis report of the Q4 release is the harsh, necessary transition from vision to actual viability. The theoretical models are finally, meeting the reality of unit economics.
And I have to say, diving into the nitty-gritty of a corporate turnaround like this is endlessly fascinating to me.
Oh, yeah.
It's the ultimate high-stakes operational balancing act. So whether you're an investor meticulously tracking the industrial energy sector or a green energy enthusiast wanting to see these technologies actually scale.
So I'm just someone who loves a dramatic corporate pivot.
Exactly. You're in the right place. We're going to dissect the specific milestones PLG is laying out for the next 3 years.
Because the maneuver from growth at all costs to a sustainable self-funding business is arguably the hardest transition an industrial manufacturer can make.
Without a doubt.
And the numbers we're about to explore show exactly what that operational friction looks like in real time and why Wall Street is reacting the way it is today.
Okay, let's unpack this, because the top-line takeaway from the analysis report is a significant operational milestone.
A huge one.
For the first time in recent history, PLG achieved a positive quarterly gross margin.
Finally.
Specifically, in Q4 2025, they crossed the threshold to a positive gross margin of 2.4%.
Now, 2.4% might sound incredibly tight to some people.
Right. If you're in traditional software tech, 2.4% sounds like a rounding error.
Exactly. But what's fascinating here is the delta between where they are now and where they were just 12 months ago.
Right. Let's talk about that historical context.
Yeah. If you look at the context provided in the report just 1 year prior, so Q4 of 2024 PLG Power posted a gross margin of negative 122.5%.
Negative 122.5%. That's just catastrophic.
It is. So to engineer a swing from negative 122.5% to a positive 2.4% in a single calendar year, that is an incredible inflection point.
It fundamentally alters the investment thesis, doesn't it?
It absolutely does. Crossing into positive territory, even by just a few hundred basis points, means the underlying business model has been validated on a foundational economic level.
Meaning they're finally yielding more revenue from their products than the physical cost to make them.
Yes, they can finally sell the products for more than it costs to manufacture and deploy them.
It's like, imagine you're making a handmade product, and for years you're losing money on every single sale because the raw materials cost more than the price tag.
And you're just making it up in volume, which never works.
Right. And then finally you tweak the process and you make a tiny bit of profit on a sale. That's the milestone they just reached. Let's ground this in the specific metrics from the report so you can see the full financial snapshot.
Go for it.
Total full year 2025 revenue hit $710 million.
Which is a solid 12.9% year-over-year growth.
Yep. And zooming in on just Q4 of 2025, revenue was $225.2 million.
So that's a 17.6% year-over-year growth.
Exactly. But the metric that really caught the market's attention was the adjusted EPS. It came in at a narrow loss of just negative 6 cents.
Which actually beat analyst estimates, right? They had projected a loss of 10 cents.
They did.
And that revenue growth indicates the commercial demand for green hydrogen infrastructure hasn't evaporated. I mean, they're still expanding the top line.
Right, the market is still there.
But the adjusted EPS beat paired with that positive gross margin demonstrates that the core operations are finally tightening up.
Yeah.
They're getting a grip on their supply chain logistics and manufacturing efficiencies.
It really reminds me of the solar panel manufacturing boom in the early 2010s, or, even the early margin struggles Tesla faced when scaling the Model 3.
Oh, that's a perfect comparison.
Because when you're building complex physical infrastructure, whether it's an EV, a solar array, or in this case, industrial-scale electrolyzers and fuel cell stacks. Scaling production initially just destroys your margins.
Absolutely. You're paying a premium for raw materials, your labor force is inefficient, your defect rate is high.
Right, so hitting that 2.4% margin is the equivalent of finally working the kinks out of the assembly line. Machine is finally working as intended.
You can't scale a negative margin in heavy industry indefinitely without eventually diluting your equity to zero or just going bankrupt.
Yeah.
Halting that specific operational bleed is why institutional investors are viewing this Q4 data as such a pivotal indicator.
But we do have to pivot to the less glamorous side of this analysis report.
The elephant in the room.
Yeah, the giant elephant in the room. Because while that adjusted EPS was a narrow loss, the GAAP net loss for 2025 was a staggering, just eye-watering $1.63 billion.
Yeah, with a B.
That is a towering figure that immediately jumps off the page and demands an explanation.
It does.
Yeah.
But if we connect this to the bigger picture, a $1.63 billion GAAP loss looks daunting, especially right next to a newly positive gross margin.
Right, it feels contradictory.
But the analysis report provides vital context for that figure. That $1.63 billion was heavily inflated by approximately $763 million in non-cash asset impairments.
And crucially, those impairments were taken specifically in the fourth quarter.
Exactly. That's a critical distinction because when you see $1.5 billion loss, your immediate assumption is that cash is just hemorrhaging out the door to keep the lights on.
But nearly half of that was just an accounting adjustment.
Right. Management took a hard look at the balance sheet, evaluated the carrying value of their historical assets against current market realities, and just wrote them down.
They essentially executed a classic kitchen sink quarter.
Exactly. In corporate finance, when a company is initiating a substantial strategic shift, there is immense value in recognizing all your historical missteps or sunken costs at once.
Just clear the decks entirely.
You don't want to drag out asset write-downs over 6 or 7 quarters, creating this constant drag on earnings.
Right.
You take the pain in one concentrated chunk, acknowledge the past overvaluations, and reset the baseline. It ensures that future quarters, where operational improvements are expected, aren't overshadowed by the ghosts of past capital misallocations.
It's the corporate equivalent of a new sports coach taking over a struggling franchise.
Oh, absolutely.
What does a smart coach or general manager do in their very first season? They cut all the bad contracts, they eat the dead money for a year, and they accept a terrible win-loss record in season 1.
Why? To ensure that by season 2, they have a completely clean slate.
Exactly. They have the financial flexibility to build the organization they actually want. By taking that $763 million impairment now, PLG is setting up its future comparables. They're telling the street, the closet is cleaned out.
And that analogy is incredibly fitting because the $1.63 billion GAAP loss and the subsequent debt clearing were directly tied to a major transition in the C-suite.
Right. The report highlights that the recent stock surge, a jump of over 11% today, wasn't merely a reaction to the numbers.
No, it was the market pricing in the March 2nd, 2026 leadership transition.
Jose Luis Crespo officially succeeding longtime leader Andy Marsh as CEO.
And this is a foundational piece of the narrative. I mean, Andy Marsh was the architect of PLG for a very long time.
He steered them through that whole era of aggressive top-line expansion and really evangelized the hydrogen economy.
He did. But as of today, Crespo is at the helm. And Crespo's background brings a distinctly different operational rigor to the CEO role.
The report details that he served as the chief revenue officer prior to this appointment.
Right, and he carries massive credibility within the industrial sector. He is the executive largely credited with architecting PLG's $8 billion commercial pipeline.
$8 billion in a commercial pipeline. That's not theoretical white paper demand. Those are tangible, negotiated relationships.
Precisely. He was instrumental in securing the foundational contracts with logistics titans like Amazon, Walmart, and Home Depot.
Those are enterprises with the most rigorous, unforgiving supply chain requirements on the planet.
Without a doubt. To secure and maintain vendor relationships with them requires a level of operational consistency that Crespo clearly knows how to deliver.
And because he's coming from the CRO position, his new mandate as CEO makes perfect sense. The analysis report highlights that Crespo is officially pivoting the company's core directive.
The era of growth at all costs is officially over.
Yep. The new internal mandate is disciplined, sustainable profitability.
It represents a profound shift in corporate DNA. When your background is revenue generation, your primary focus is understanding exactly what the enterprise customer values and how to deliver it at a premium.
Yeah.
Moving the CRO to the CEO seat signals to the market that the focus is no longer on simply subsidizing the technology just to prove it works. The focus is strictly on optimizing unit economics.
Here's where it gets really interesting. Because Crespo didn't just step into the corner office with a vague motivational pivot.
No, he brought a plan.
He brought a highly specific, aggressive internal initiative with him, dubbed Project Quantum Leap.
I love that name. Project Quantum Leap is the operational engine behind this entire turnaround thesis.
And the analysis report breaks down this initiative into 3 distinct operational pillars.
Let's analyze those pillars. The first is raising prices to reflect true market value.
Which is bold.
It is. For years, PLV likely utilized introductory or loss leader pricing to incentivize adoption and build market share in a nascent industry. Crespo is essentially declaring that the technology has proven its operational worth, the broader market is maturing, and the pricing structures must now reflect the tangible value and emissions reductions they're delivering to clients like Amazon and Walmart.
It's a remarkably bold move. I mean, you have to be incredibly confident in the stickiness of your product to go to major Fortune 100 anchor clients and say, the introductory pricing phase is over. We need to renegotiate these contracts at a higher rate.
It requires immense confidence, yes, but it is an absolute necessity for survival. You cannot build a sustainable business by continuously subsidizing your clients' green initiatives.
That point.
The second pillar is streamlining the workforce and driving manufacturing efficiencies.
And this ties directly back to that positive 2.4% gross margin we discussed earlier.
Exactly. You don't engineer a 125 percentage point swing in gross margin without finding substantial ways to manufacture faster, reduce component waste, and optimize the labor hours required per unit.
And what about the physical hardware itself? That brings us to the third pillar of Project Quantum Leap.
Right. The third pillar focuses on driving down the physical costs of the fuel cell stacks and the electrolyzers. This is the core hardware of the green hydrogen infrastructure.
Right.
By focusing their materials, science, and supply chain engineering strictly on reducing the physical cost of producing these modular units, PLUG is working both ends of the margin equation.
Raising the contractual price they charge the customer, while systematically lowering the internal cost to manufacture the machinery.
It is a textbook margin expansion playbook applied to heavy industry.
And under Crespo's leadership, management has taken this strategy and drawn a highly specific 3-step line in the sand for the coming years.
Yes, the 2026 to 2028 roadmap.
Think about how rare it is for a company, especially in a volatile, capital-intensive sector like green tech, to offer such a rigid, multi-year timeline for institutional investors to hold them accountable to.
It's almost unheard of. Usually management teams hide behind vague, forward-looking statements about, long-term value creation.
Exactly. But this report lays out a very explicit roadmap to profitability.
And the transparency of this roadmap is undeniably what gave Wall Street the confidence to bid the stock up 11% today. It provides analysts with a measurable, sequential checklist.
So let's walk through that timeline detailed in the report.
Sure. Step 1 is targeted for the end of 2026. The explicit goal here is achieving positive EBITDAs.
So the immediate near-term objective for the end of 26 is to simply stop the operational cash bleed before we factor in things like interest, taxes, depreciation, amortization, and stock-based compensation.
Correct. It's step 1 of stopping the hemorrhage at the operational level. It proves the day-to-day business operations are no longer structurally deficient.
Okay, and step 2?
Step 2 is targeted for the end of 2027. The goal here elevates to positive operating income,
Which is a significantly higher hurdle.
much higher. Achieving this by the end of 2027 would prove that the core business can completely sustain itself operationally without needing outside funding.
Meaning gross profits are robust enough to cover all the operating expenses, R&D, sales, marketing, and general administrative overhead.
Precisely. It transitions the company from being a capital consumer to being self-sustaining.
And that leads to the ultimate finish line.
Step 3, the end of 2028. The goal is full profitability, net positive GAAP earnings, and the total completion of the turnaround.
So what does this all mean for you as an investor tracking this space? It means management has removed the ambiguity.
Completely.
This isn't just corporate optimism. It is a highly measurable checklist that you can track quarter by quarter. When the next financials are released, you don't have to guess what matters. You look right at that trajectory and hold them accountable.
This raises an important question, however.
I was wondering when we get to the catch.
Right, because while the strategic roadmap is incredibly clear and the initial gross margin inflection is promising, we have to look objectively at the massive risks that still remain.
A strategy is merely a strategy until it's fully executed.
Exactly, and the financials in this report are very clear-eyed about the liquidity dangers still lurking. Despite that 2.4% positive gross margin, the operating cash flow in 2025 was still deeply negative.
Yeah, they burned through $535.8 million in operating cash flow over the year.
Right. Achieving a positive gross margin on hardware sold does not immediately erase $500 million of broader operational cash burn.
But the report does point out this negative $535.8 million burn is technically a 26.5% improvement from 2024.
Yes, the rate of cash consumption is slowing.
But I'm going to push back on that a bit. A 26.5% improvement is a silver lining, sure, but they are still entirely reliant on external liquidity to survive.
Oh, absolutely.
Because the math problem here is tough. The Q4 filing shows they have $368.5 million in unrestricted cash.
And they burned $535 million last year.
Right. So even with the improving burn rate, $368 million cuts it incredibly close for stabilizing liquidity through 2026.
They cannot just rely on the existing cash in the bank to bridge the gap to that first profitability milestone. That is a mathematical impossibility.
So how are they bridging the gap?
To solve this equation, they are actively executing over $275 million in asset monetization.
Meaning selling off non-core assets or leveraging existing infrastructure to raise capital.
Precisely. And the analysis report highlights a very crucial piece of this monetization strategy. PLG recently signed a $132.5 million definitive agreement related to U.S. data centers.
Now that is a fascinating macro tailwind to tap into.
Huge.
With the boom in AI, data centers are incredibly power hungry, and grid capacity constraints are forcing operators to find clean off-grid power solutions.
And that $132.5 million agreement injects critical capital right when the balance sheet demands it most.
It frames this entire situation as a thrilling, high-stakes race. When you strip away all the complex engineering, the stock's ultimate survival depends entirely on one single factor.
Can Crespo and Project Quantum Leap shrink the cash burn faster than that unrestricted cash pile depletes?
It's a race between the efficiency of the new business model and the reality of the bank account.
And the margin for operational error is virtually zero.
It really is. Well, it's been quite the journey today as we've unpacked this analysis report. We've synthesized the transition from a history of massive cash burns to a promising 2.4% positive gross margin.
We covered the strategic debt clearing of that $1.63 billion gap loss.
And we looked at the high-stakes race between Crespo's Project Quantum Leap and the depleting cash reserves.
As we wrap up, I want to leave you with a final thought to ponder that builds on this analysis report.
Let's hear it.
If Pilik Power actually pulls off this strict 2026 to 2028 roadmap, it doesn't just save their stock, it provides a blueprint for the entire green energy sector.
Well, yeah.
It forces us to ask, are we finally leaving the era of green tech hype and growth and entering the era where these technologies must operate as ruthless, self-sustaining, profitable businesses?
That is an incredibly compelling angle to consider. The shift to profitability might just change the entire industry landscape. Well, thank you so much for joining us on this deep dive into the analysis report. We hope this breakdown gave you a sharper view of the high wire act they're currently performing. Keep asking questions, keep looking at the raw numbers behind the headlines, and as always, stay insanely curious. We'll catch you next time.
Don't forget to like, share, and subscribe for more.